Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast, the podcast where Andrew and I talk general investing concepts. To get even more content from me and Andrew, sign up for the Focus Compounding app. The Focus Compounding app costs $7.95 a month. It comes with a bunch of 2,000-word articles from me each week, a fresh batch of 5-minute videos from the both of us, along with one bonus extra-long episode of the podcast each Saturday, and immediate access to our complete backlog of 200-plus episodes. To sign up, go to focuscompounding.com/app or wherever apps are sold. And now here's Andrew with your regularly scheduled podcast.
Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding. Sitting next to Geoff Gannon. Jeff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. I can't believe it's already September.
It's halfway through September.
I can't believe it.
Okay.
We got a couple months left. It feels like it's true. Till that we're going into the holiday season, the best time of the year. Are you a big Halloween guy? Do you give out candy for Halloween? Do people even go to your place on Halloween?
No.
Got it. Halloween. And then we got Thanksgiving, Christmas. This is the best time of the year, Jeff. This is the giving spirit. Everyone's in a good mood.
Okay.
Into the end of the year. It's been a good one. It's been a wild one. Well, thank everybody so much for tuning in. If this is the first time you're tuning in, hit that subscribe button. Today's video, we are going to be going over the cash flow statement.
Okay.
We just went over the balance sheet, and we are going to go over the cash flow statement and go and see, what you look at first, how you interpret things, and then kind of go from there. So we are looking at Dave & Buster's.
Right.
And here we are.
Got a few things that are interesting right away. The number one that stands out to me is that they have 3 years.
I was gonna say I like that they have 3 years.
Yeah.
Gosh, normally I'm having to go back and forth.
It's easier,
yeah.
But a lot of companies use 2 years. They just show you 2 years. And so, it'd be curious what people. So the first things I look at, all right, for the cash flow statement are just simply, and this is easier because there's 3 years of it right here. What's the net cash provided by operating activities? Just jump right down to there. And I eyeball that. And then I eyeball the capital expenditures. Here, they're very even. Not exactly even. Like there was $120 million more generated in last year in CFFO over CapEx. But overall, what we're seeing is that it's pretty close. This is unusually close. And that might be telling us that there's a lot of growth CapEx at this company, maybe. And so we have to learn more about that. But this is what I do first. I just assume, okay, pretend all the CapEx is like maintenance CapEx or whatever. How much free cash flow are they generating each year? And that's the main thing that I look at. Don't spend a lot of time looking at the bottom items, cash flows from financing activities. And then I do spend a little time looking at some other things if we go up on the cash flows from operating activities. There's actually some kind of complicated ones here for this company, which is interesting. But they're not necessarily very big items, but just things to point out that change the cash flows versus the income stuff. So if you look, it's very helpful that, I don't know if people think about this, but because GAAP accounting stuff that is presented for us is always going to use the reconciliation method, so it's going to take income and then move from there to get you cash flows. It never uses the direct method of actually counting cash for you. That's way too difficult for a company to keep track of. So it actually shows net income right at the top. So if you've never thought about that before, you can actually find the net income number right at the top of the cash flow statement. So balance sheet first, then right to cash flows. So the big item here, right, is depreciation and amortization, right? Really big item.
Yep.
So if you look, I think it's about even net income and depreciation and amortization each year. So in a sense, your cash flows, meaning like your EBITDA, is coming half from actual earnings that you reported and half from your depreciation, which means it's pretty important what actual level of CapEx you need. And it seems high, the amount of CapEx that they actually need here. But maybe they don't need it. Maybe they've been growing a lot. Maybe they're expanding.
When you look at numbers, and this is something I'll do, so my eyes would probably go directly to net income and then to cash flow from operating activities and see that dispersion there. So that'd be like, okay, what's going on there? But I'm constantly trying to add context to these numbers. So I'll remember that, it's an $800 million market cap. So I'm kind of like thinking, okay, well, let's say the average is, I don't know, $300 million over the past 3 years, and it's currently trading at $700 to $800 million market cap. To me, that just kind of adds context to the story. That's just something I do.
Yeah, I think it makes a lot of sense. The other thing is if you notice any weird items that you weren't expecting there and stuff, and whether they're meaningful. So loss on debt refinancing is an unexpected item here, but it's not very meaningful. There is one that's a little more meaningful, which is the loss on disposal of fixed assets. So it's not a huge number, but it's interesting because they've lost money every year on their disposal of fixed assets. So then it's a question of like, does that mean that they sell off some of their equipment every year and lose money on? Is that what it is? Something like that, you know? So we can go to another company.
Do you, really quick though, do you look at, for example, when this line item, accrued liabilities, in 2019 and 2018, it was, 20 million, and then it just jumped to 47 million in 2020. Is that something that you would like go and investigate, see what happened? Is that something that would jump out to you?
That's accrued liabilities there. Yeah. And yes. So I would look at that over time, but my guess is that that's going in the same direction over time and is probably getting bigger. You are, however, right that it doubled, which is a lot, but we only have 3 years, so it's possible there was just a coincidence with the last 2 years being the same sort of size. But yeah, if it had been like 20 million every year and then suddenly jumps to 40 million, then I would potentially think about that. But yeah, the main thing is whether it's those items, working capital items, is whether it's always positive or always negative or something like that. A lot of people ask about it, and for things, the most common one is like people say inventory. Yeah. For a lot of companies, inventory will swing back and forth that way. So it'll be a contributor to cash flow over earnings in 1 year and then reverse next year.
So let's look at Berkshire Hathaway's
cash flow statement. Yeah, pretty useless. But yeah, we'll do it. Go ahead.
So you got 3 years. You like to see that. But so their net income could be all over the place because of the way that they have to account for that. How would you analyze like a investing company, I guess like a conglomerate? How would you typically try to analyze that?
I mean, you can't. It's useless because they own finance companies, which cash flow statements for finance companies are just not useful to see. What's worse here is Berkshire is completely confusing because remember the depreciation and amortization is including things like railroads and utilities in the same company that's including stuff for unearned premiums and things like that. Because it's an insurance company. It actually also has a finance operation to it too. So it can be very confusing that way. You can, however, see that, you can, if people wonder what float is and stuff, you actually can see that. So changes in operating assets and liabilities does actually show you that's float basically. So what it's showing you is loss and loss adjustment expenses, deferred charges, reinsurance assumed. We won't get into all that, and unearned premiums. But it's those items, if people are like, how do I find out what the float is? There's a better way of doing it with the balance sheet, but which is what I encourage people to do, is to find the float on the balance sheet. But if you actually want to see the float coming onto a company and stuff, it is that you can see it in the changes in the assets and liabilities that they show there. So you can see that there's items here like in 2017, right? We have a very big item for loss and loss adjustment expenses, but that isn't a cash outflow at that moment. So this gets pretty complicated this way, but Berkshire takes in its insurance operations, it takes in cash and immediately charges itself for losses and things. And it then has cash on hand when it does that. And then the reinsurance thing works pretty much the same way. So yeah, you can see that it takes on sometimes a lot of assets, a lot of cash that you can see. If you go all the way down, let's see if you go all the way down. Does it have this information for you? Let's see.
Acquisition of treasury stock.
If it bought back stock. So
where do you want me to go?
It is cash. Okay. There we go. So it has restricted cash end of year. It actually breaks it down. That's what I thought it would do. So if you can see, it separates its insurance operations. So you can see that its insurance operations have almost all the cash in them, right? Yeah. So that just gives you an idea of where they house it.
Let's look at Microsoft.
Okay.
Let's see.
Just go to financial statements and supplementary data. Right.
Let's find it. Here we are.
All
right. So first thing, net income they have here, 3 years again. Very nice. Cash flow from operations. There's a dispersion between net cash from operations and their net income.
Yeah.
Why is that?
So, they have, let's see here. They have quite a bit higher cash from operations than they do their net income, right?
Correct.
Okay. So we can look at why that is. A few numbers jump out right away. As you'd expect, stock-based compensation. So stock-based compensation is there. But the bigger number is depreciation, amortization, and other. Okay. And then there also should be an item down here that should be a source of float too, which would be your unearned revenue is a common one. So unearned revenue and deferred revenue are basically going to be the same thing. It's float, as we talked about before. So I don't know if is it confusing to you what unearned revenue is?
It's like a subscription business, right?
Yeah. So,
like if we get a annual member, you take in the cash today, but the way you account for it is monthly.
Right. So it's a matching off thing, which is a big principle in all sorts of GAAP accounting things that you have to keep in mind. Is that there's two things that they're worried about. One is that you actually book things. So like there's an event that takes place. That's one thing that I think people get confused about and stuff. You don't carry land on your books at the value of the land unless you like buy or sell some land to have an actual transaction. That's a big principle. But the other principle is that you want to match off things in each period, match off the expenses and the revenue. And so like depreciation stuff, one thing that confuses people, I think, sometimes is it's not like a sinking fund for a future thing that you're going to pay. It's just that you're taking out an expense that you had and smoothing it over time instead of having a one big lump there. So what they're trying to match with revenue here is if people pay you up front and stuff, you want to match that with the cost over time of providing the service. So like you said, over those 12 months or whatever that you pay, that you actually provide the service. So the result is that you get some float from that.
Yeah, I mean, it's like, I'm sure Office has annual memberships and stuff like that. You know, people pay up front and then, you know, it's great business.
Yeah. Yeah. And even balance sheets that are prepared on so we're looking at the cash flow statement, but just so people know, even a balance sheet that's prepared on at any time for a business that has monthly things, you'd still be in the middle of a month. So you just like you'd be in the middle of a pay period and stuff like that. So you do have some amount anyway from that. So yeah, you have a large amount of flows from all of that. The one thing, there's a tax thing too, I guess, that was meaningful in 1 year.
Income taxes.
Was income taxes meaningful? Yeah, there's a very big item there that I don't know.
Could that be the new tax, Trump's tax thing?
Yeah, I don't know what that is, so we just have to look into that. But anyway, what you should see, hopefully, I guess, is a more stable number in terms of cash flow from operations over time than, in fact, you're seeing in net income, which probably makes sense because there's a huge decrease in net income in the year where there's that tax thing. So whatever that was a tax charge, I guess, maybe. So that hit earnings, but wouldn't have hit any sort of cash thing.
You know what we should look at? We've been talking a lot about GE on here. Okay. And one thing I haven't done, but I did want to do, we could do it on here, is look at their cash flow statement from about 10 years ago. Because of QuickFS, we get 20 years of financial data. How cool is that? All right, let's see. We go to their cash flow statement.
Right.
And we could go back. So let's see.
We see free cash flow there.
So I just want to see like the dispersion between, net income to cash flow from operations and what it looks like.
Okay. We can look at things like that. So there we can do that. We can also look at like Key ratios would be a really good way of seeing that, actually, I think. So if we have, so free cash flow margin and net income margin. So theoretically, a company would have pretty similar numbers if it was, some of the companies we invest in and stuff do. So if it doesn't generate float or use up assets that way, then like tie up things in capital, then it would basically be flat in terms of the two of them. Like a software business or something that isn't really having float would look that way. A TV station might look that way, things like that. So then you have companies that generate a little float, and then you have like heavy manufacturers and stuff, which might actually have much lower free cash flow than net income. So if we look at GE over time, for one, we can just like because you're in Excel, you can just like highlight the two. I guess you have to enable editing, but do you have to enable editing? I think so. You have to go there. Yeah, like, so you could select both rows. Just like, start it with 9.8% and then, click on 9.8% and go over.
Where are we talking about?
Here on net income margin.
Oh, got you. Okay.
Yeah, so select that and the row below it together. And then all the way over, and it should give you, if you do each of them, it should give you like one of, okay. Anyway, you can figure out the averages of them using it.
You want me to figure out the average?
Yeah, if you just select it in Excel, all the things, it'll display the average at the bottom. It'll do the mean, and it'll also do counts and stuff for you. So like, if you have the averages?
Yeah.
All right. So what's the difference in the averages?
The free cash flow margin is a little bit more than double, or I guess you could, net income margin.
The free cash flow margin is a lot higher. However, it seems consistently pretty high to me. In fact, very high. So the question is, what's going on there? I don't know. And this is one of the reasons why it's hard to figure out things like GE. I don't understand it, and I don't know what it's measuring. We aren't looking at their actual cash flow statement, so we can't see why it has numbers that high, that are so much higher than its reported earnings. Don't know.
Interesting.
In fact, if we look at other things too, we can see that over time leverage had been coming down for a while. Now it went up recently, but it wasn't having increasing leverage in terms of assets to equity is a simple way of looking at it. So we don't see signs of increasing problems with leverage, nor poor free cash flow generation or anything like that. So it's hard to see. Let's see. Let's go to like the cash flow statement.
Look at that market capitalization. So what's this, 2000?
Well, they peaked there as one of the biggest companies in the world.
57 billion and down to 97 billion.
Yeah. So if we look at the cash flow statement, we can see what they generate in operating cash flow, which is a pretty easy way of doing it over time. So if we look, this is one of the most obvious tip-offs of like the actual underlying business, I would say, is the just cash flow from operations. So there is a bit of an issue here in that, when did that peak?
It looks like 2008 was 48 billion.
And since then?
It has gone down to...
Yeah. So that's a pretty easy way of looking at it. So I don't know what the net cash flow, the free cash flow number included. See, there's acquisitions and divestitures. There's net purchase of investment. I don't know all the things that's in here, but to be honest, when I look at companies and things, there's a few numbers that are really easy to focus in on that I think that are hard to kind of, not that they're hard to fake, but whatever. You're usually not going to be misled by gross profits or cash flow from operations. One, I don't think those are things that companies target to tell investors about.
Yeah.
And two, I think that they are good underlying trends of the business. Sometimes gross profits hold up with some companies, but cash flow from operations fall apart. And that may be because their inventory is building up too much or whatever, things like that. But net cash flows from operations is a pretty good example of a thing that you could focus in on and have a good idea from. You see that there. So I guess maybe they decrease capital expenditures a lot at GE or something. Or this is calculating, including things they're getting rid of too, which I don't do. People disagree with me on that.
Look at all that net financing cash flow since 2008. Just been all red.
Yeah. So
majority in net issuance of debt Yeah, I mean, they've raised a ton of debt.
Yeah. So yeah, I would look at so if we look at net operating cash flow, right? Mm-hmm. We start in like 2000 and stuff, and you have 22 billion or whatever. It's not an amazing trend or anything over time, but it is mostly an upward trend that is pretty fine for a big mega cap company, something from 2000 to 2008. It looks fine to me that way. And then you get to around the financial crisis, and it drops by a tremendous amount and really has trouble recovering from there once it peaked. So if we look at net income too, though, if we look over there, we have a similar thing with net income. I mean, very flattish over time. If we go to later years, let's see. Yeah. So net income didn't really increase after the financial crisis. The relationship between net income and net operating cash flow doesn't seem tremendously different to me. Those are other ones. I don't know if they have those in Quick Invest. We go to key ratios. But one way is you can divide one of those numbers into another to get tests of quality of earnings and stuff. So if you look here, we could do this for ourselves, but like you see the per share figures and stuff. So if you look, you could see things like, you have like operating income and things like, let's see, if we go up a little bit, let's see, does it have, yeah, actually most of these numbers are pretty stable going in the same direction.
What are you looking at?
I'm not seeing a big difference in terms of conversion rates of what they have from like converting free cash flow as free cash flow as compared to like things like operating income and stuff like that. So I compare net income. A common one to do is net income and free cash flow. You could see that in the margins, obviously. And I don't see dramatic differences. It's not like, I mean, there were some years where it changes a lot. So you do notice in some years, I'm not sure what that's all about because we don't have the balance sheet we don't have the actual cash flow statement to look at. But for some reason, right after the financial crisis, we have very high free cash flow numbers compared to net income. And maybe it's because they charge off things and stuff related to finance things, or maybe it's because they cut down on like capital spending and stuff after that. Yeah.
Interesting. Cool. Want to thank everybody so much for tuning in with Geoff and I on the Focus Compounding Podcast. Make sure you hit the subscribe button if you do want to sign up for Quick FS, which is where I pulled these historical financials. Make sure you tell them you came from Focus Compounding. I want to thank everybody so much for tuning in. Thank you so much for all the support, and we will see you in the next podcast.